Okay, starting off chapter 1 here. The financial manager's roles and responsibility. We'll start off with the primary objective. The primary objective, like you can see on the left side here, is wealth maximization. So the primary objective of a financial manager is the shareholder wealth maximization. This is the key thing that you have to remember, is to maximize shareholder wealth responsibly. This is the key objective, primary objective. However, they have to also ensure that they keep in mind the interest of the other stakeholders as well. These are the other stakeholders. They have to keep in mind the other stakeholders' interest as well. Financial managers support long-term businesses through financial decisions. The biggest benefit a financial manager brings in is the financial decision that he makes. And ethical decisions, profit-making decisions should also consider ethical and legal responsibilities. They should also consider ethical and legal responsibilities. They should also consider ethical and legal responsibilities. And finally, financial decisions would create value, should create value without harming stakeholders. They should create value. They should create value without harming stakeholders. They should create value without harming stakeholders. They should create value without harming stakeholders. So this is all about the financial manager's role. Okay, so let's look into this here. Now let's get a good understanding. Okay, so let's go through the red part here, the most important parts here, Shri, for all the points quickly. What is the primary objective?
So the primary objective for a financial manager is to maximize the shareholder wealth.
Okay.
And then while making financial decisions, so you should basically consider or keep in mind about the other stakeholders also. The other stakeholders include employees, customers, society, government, and the environment. And the strategic role of financial managers, he should support long-term business success through financial decisions. And ethical decisions is that he should also consider ethical and legal responsibilities. And then you should create value without harming stakeholders.
Stakeholders. Okay, so nothing complicated here. We've got it. The most important part I put it in red also, just so that when you're reading, you understand the whole context. Moving on quickly here. Second, the financial manager's key areas of responsibilities. We look into the key areas of responsibilities. So first is investment selection here. So decide where the company fund should be invested. Okay, where? Where is very important. Where the company fund should be invested. That is the first part. Where? Once that is done, raising finance. Obtain finance at the lowest possible cost. So you have to start look to get finance for the company at the lowest possible cost, like the cheapest finance that they can without compromising on the capital structure. Next, distribution and retention. This is about how much profit to distribute as dividends, right? How much profit to distribute and how much savings to make, how much to distribute, how much to save. These are yet another set of decisions made. Next, financial planning. You have to prepare budgets and monitor the financial performance. So next is you have to prepare budgets. So prepare budgets and monitor the financial performance. Okay, and monitor the financial performance. Next, we look into risk management. Identify and manage financial risk affecting the business. Identify and you have to manage the financial risks affecting the business. Okay, these are the main key responsibilities of a finance manager. Okay, let's go through this quickly here, Rashi.
So the financial manager's key areas of responsibility. First is the investment selection. So he should decide where the company's funds should be invested.
Yes.
Second thing is while raising finance, he should make sure that whenever he's obtaining finance, it should be at the lowest cost.
Perfect.
Distribution and retentions, he should decide how much the profit he should retain. And then financial planning is like you should know how to prepare budgets and monitor the financial performance of the company.
Yes.
Risk management, you should identify all the financial risks that's affecting the business and manage them effectively.
Perfect. Yes, perfect. I'm so glad you have the complete clarity on this. Let's move on now. Strategic investment and capital allocation. So now we are looking into the strategic, the first one over here, as you had seen here. Where to invest the funds, maximize the return. We are looking into the first one, investment selection. As you see here, investment selection is what we're looking into one by one. Then we look into cost. Okay, so let's start with investment selection. Then this was the cost. Okay, then this is the distribution policy. Then the communication. Then financial planning. Okay, then management of risk. Okay, so you see everything we have just studied, we are looking into in detail. All these points we are looking into detail. So you're seeing the structure of the chapter, Yashi, that all of the responsibilities one by one we are looking into detail. That's what we're doing. Okay, the chapter started with understanding the key role. What is the key role, Yashi, quickly? Primary objectives.
Maximizing the shareholders.
Perfect. So that was the key role. We understood that in the first slide over here. Now what we are looking into is what are the other responsibilities, and the next 7 slides is just talking about the other responsibilities. That's it. To understand the structure, see content in one thing, structure of the chapter you have to also understand. So it keeps your revision very clear. So first we understood what is the primary objective. Then we looked into other responsibilities. Now we are looking into the other responsibilities at a little more depth. That's all. Okay. So that is pretty much the first 10 slides of the chapter. Okay, are you able to create that structure, Shri, of the first chapter in your mind?
Yes, sir. Yes, sir.
Okay, so this is exactly how we are going. So we got the idea about the roles, then we looked into high level each. Now we look into in detail all the roles, all the responsibilities in detail we are looking into. That's it. So that's how the first 10 pages or the first 10 slides of this particular PPT has been structured. Moving on now. Now looking into the first one here in detail here, that is the strategic investment and capital allocation. So you have to use techniques like NPV and IRR to evaluate projects. So this is something you would have studied in FM also, and you will be
Yes,
using
sir.
NPV and IRR to evaluate the projects, which one should do or not. Next, consider the environmental and social impacts before investing. You have to consider the environmental and the social impacts. Before you invest, you have to consider how it will affect the society and the environment as well. Select the best project because the company has funds that are limited. No one has unlimited money. There's always a limitation on the money. So you can only do a certain amount of. If you go to a mall, most of the people they will only be able to buy a certain amount of quantity from the mall. They cannot probably buy the entire stuff that is there in the mall. They can only buy a certain amount of quantity. So when they have the only limited certain funds, so they have to allocate it to buy the best thing that is suiting them. Next, corporate objectives. Investment should be supporting the long-term business goal. Investment should basically support the long-term business goal. Very important. And finally, shareholder value. Good investment decision increase shareholder wealth. Yeah, good investment decisions. Good investment decisions increase shareholder wealth. And what does good investment decisions do? They increase shareholder wealth. Good investment decisions, they increase shareholder wealth. Okay, good investment decisions, they increase shareholder wealth. Okay, so that is about this. Good investment decisions increase the shareholder wealth. Good investment decisions increase the shareholder wealth. That is very important. Okay, so good. Increase the shareholder wealth. Okay, so this is pretty much about strategic investments and capital allocation. Is finally they have to use NPV and IRR. Second, when they make any decision, environmental and social impacts have to be considered. They have to look into the select the best projects because the funds are limited. They don't have unlimited money. Investment should support long-term business goals. Your investments should basically support your long-term business goals. Your business investment should support your long-term business goals. And finally, shareholder value. Good investment decisions increase the shareholder wealth. If you make good investment decisions, it would increase the shareholder wealth. Good investment decisions, what they would do, they would increase the shareholder wealth. Good investment decisions would increase the shareholder wealth. Okay, good investment decisions are increasing the shareholder wealth. Very important. Good investment decisions are going to increase the shareholder wealth. Okay, so this is pretty much everything around the first part here, that is strategic investment and capital allocation. Everything is simplified here. Now, if you take good investment, what are the benefits? And then you have to support long-term business goals, select funds which are making the maximum return, or projects which are making the maximum return, and ethical consideration, investment appraisal. Okay, so all of these things we considered under the strategic investment and capital allocation. Okay, so these are all the points that we have looked into from a very clear perspective. So that what techniques we'll be using, and along that what impact we have to consider. Then since the funds are limited, what we'll go for. We have to be very mindful of that, and we have to support long-term business goals, and we have to ensure that good investment decisions are being made. Okay, let's go through this quickly, Yashi, in short.
Yes, so when we look at strategic investment and capital allocations, for investment appraisal, we should use techniques like NPV and IRR while evaluating the projects. And then while doing that, we should also consider the environmental and social impacts before investing. And then because of the limited funds, we should always select the best projects that provide maximized returns. And investment should always support long-term business goals. And good investment decisions increase the shareholder wealth.
Perfect. They will increase your shareholder wealth in a massive way. Okay, so that is pretty much about us understanding from a point of view of investment and capital allocation. Okay, quickly moving on now. The second function that we saw over here, first function as you saw here was investment selection. We looked into this. Now, second function is to ensure that when you raise finance, try to have the minimum and minimal cost it should be. And when you try to raise finance, do it at the minimal cost. So firstly, you have to ensure optimal gearing. As a manager, you have to get the right balance between debt and equity in the company. Don't have too much debt also, don't have too much equity also. Just have the right balance, which is very important. The right balance between debt and equity. Cost of capital, you have to ensure that the your cost of capital is lowest overall capital. Very important. Next, sources of finance. You have to evaluate the debt, equity, and internal funding options. Right, you have to evaluate which is better for you. Should you take loan, should you raise equity, or should you use the savings of the company? Consider the tax benefits also when choosing finance. Consider the tax benefits as well. And finally, financial ratios. Financing decisions affect ROCE, EPS, and other key ratios. Okay, ROCE, EPS, and other key ratios. Okay, so that is about this strategic financing, raising capital at the optimal cost. Okay, so we understood optimal gearing, we got a good idea, cost of capital, sources of finance, tax implications, and financial ratios. So we looked into all of this here. We got a good understanding that they have to ensure that the debt and equity is in the right balance, lowest cost of capital, evaluate all the funding options, make sure you consider the tax benefits when you're choosing the finance, and ensure that financial ratios, financial decision will affect your key ratios. So always keep that in mind also from an perspective when you're raising finance. Okay, let's go through this, Shri, quickly.
Yes, so like raising capital at optimal cost, like you should always maintain the right balance between debt and equity.
Yes.
And the cost of capital should always be at the lowest.
Yes.
So the finance, before like choosing, you should always evaluate all the funding options.
Yes.
And tax implications, you should also, by choosing finance, you should also consider the tax benefits.
Very good.
And financing decisions always have an impact on key ratios. So we must also consider that.
We have to also consider that. Absolutely right. Moving on now to dividend decisions. Okay, what will be some dividend decisions that we'll have to make here from a dividend decision perspective over here? So, firstly, a dividend policy should maximize shareholder wealth. Simple. Your dividend policy should be such that maximizes shareholder wealth. Done. Second, balance giving out money versus saving money. Savings versus giving out should be balanced. Very important. Don't give out too much. Don't save too much. Reinvestment. You have to retain the profit to finance the positive. So retain some profits, retain profits to finance positive NPV projects. What you have to do is you have to retain profits. And finally, investor preferences. Consider whether investors prefer dividends or capital gains. You have to consider whether investors prefer dividends or capital gains. Okay, consider whether investor prefers dividends or capital gains. Consider whether investors prefer dividends or capital gains. Okay, then develop an appropriate distribution and retention policy. You have to develop an appropriate distribution and retention policy. You have to develop an appropriate distribution and retention policy. A policy should be strong. How much you save, how much you give out. See what the investors prefer. Retain some profits, at least don't give off everything. Balance the dividend versus the retention. And again, try to maximize shareholder wealth. The policy should be such. Okay. Let's go through this one here, Shri, quickly.
So the dividend policy should always maximize the shareholders' wealth.
Yes.
And there should always be a balance between the dividend payments and retained
Perfect.
earnings. And the company should always like retain some profits to finance positive NPV projects.
Absolutely.
And then investor prefer dividends or capital gains. There are different preferences. And then they always have to develop an appropriate distribution and
Retention policy. Absolutely right. Okay. So that is with your first 5 slides here. Now that we finished the first 5 slides, we'll just check on everything that we have done here. You just look here. First, we are okay with this. The financial manager's role. This is what they're telling us basically is shareholder wealth maximization is the main. However, he has many others. These are the many others that he has. And then in the many others, we've looked into 3 of his functions. That is him, the financial manager looking into investing money, financial manager raising money, financial manager distributing the money of the company. Okay, so these are the first 5 slides and pretty much done with this. Okay, no doubts here, Shri. We are clear. We're good to go. You're understanding everything.
Yes, sir.
Okay, and to see the whole point of me making you read it right now, so that today, when we are done with this, by the time you have the entire day, you will at least go through this 5 to 6 times minimum. Today is the first and the last time you are giving so much time to chapter 1, because every day else you will just read it once. Today you read it 6 times. Okay, the entire thing you try to read it 6 times only today, and you give the maximum time to chapter 1 today itself. Okay, so that
Yes, so
tomorrow when we are
I
doing
should
the
read,
question,
I should read the Excel file or the slides.
the Excel file.
Okay, so
Split the screen like that. Read the Excel file.
yesterday I
Look at the slide. Yeah, sorry. Yeah, sorry. You were saying something. I cut you off.
so no, so yesterday I went through the thing until whatever we completed,
Huh.
the Excel file already.
Huh.
So I just got confused if we had to go through the slides or the Excel.
Fair. So what you do is right now, I made it as per the slides only. So you go through the Excel file, but just keep the slide open next to you. So just glance through it. Let's see all the points are
Yes.
there and you're making sense of all of them. Okay, read it
Okay.
5 to 6 times. And today is the first and the last day. You're giving so much time to chapter 1.
Yes.
Okay, so today is the last day. It should be that you're giving this much time to chapter 1. Tomorrow we'll finish the questions of chapter 1, and then you have to just revise the two things. That's all. Everything I'll put the questions also here only of chapter 1. So this one Excel file you have to just read every day. Your chapter 1 will be revised every day. That's it.
Oh,
Yeah, okay, nothing else. You have just refer to this one source. That is the Excel file, and keep the PPT open. Okay, whatever sums we do also, what I'll do is I'll paste it here only in the bottom of this particular chapter only. So everything in chapter 1 will be here for you. Okay, so that's why we have to make sure that we having a good system in place. It's not just about having a class, it's about having a system. Class is one part of the system. Okay, so your system is on the day we do the chapter, you read it 5 to 6 times. Do it as much as time. If you go beyond also great, but minimum 6 times we have to read it on the day. That is the Excel file on the day we do the chapter. And once that day is done, then next day I will do the next chapter. So that chapter will be read 6 times. This you just read it once. That's it. Okay, so that is the simple plan, and just this Excel file will be your one source. Till the time you write your exam, just go through this, will be super clear to you.
yes.
Okay, all right, perfect. First 5 slides done. Let's move on now. Is communicating with stakeholders. Okay, so now let's look into communicating with stakeholders. External stakeholders, you have to provide financial information to shareholders, government, and suppliers. You have to provide financial information to all of them. Keep the managers and the employees informed. So these are the internal stakeholders. Keep these guys informed about all the financial objectives of the company. You have to ensure there's a clear communication, because that will only build trust and confidence. Ensure there's a clear communication that will build the trust and confidence. And compliance, ensure regulatory reporting requirements are met. Ensure the regulatory reporting requirements are met. And finally, business relationship, good communication supports long-term stakeholder relationships. Good communication, it will support. What does good communication do? It supports long-term stakeholder relationships. What does good communication do? It supports long-term stakeholder relationship. What does business relationship do? It supports long-term stakeholder relationships. It supports long-term stakeholder relationships. So very important to have good communication. All right, let's quickly go through this one, Yashri.
Yes, so when we look at communicating with stakeholders, we have external and internal stakeholders.
Yes.
External stakeholders, we obviously have to provide them financial information.
Yes.
So those stakeholders include shareholders, government, and suppliers.
Perfect.
Internal stakeholders include managers and employees.
Yes.
They should be informed about the company's financial objectives.
Okay.
Then, whenever there's clear communication, it
Yes.
always builds trust and confidence.
Perfect.
And then the company should always ensure that they meet with the regulatory reporting requirements.
Yes.
And good communication always supports long-term stakeholder relations.
Okay, so that's with any relationship. If you have a better communication, it will ensure there's a long-term relationship. Okay, perfect. That is slide 6. Okay, so that is about the next thing that we picked up here. Next, we have finance planning and control. Okay, what about this? So firstly, develop financial plans to achieve the objectives. So whatever the business objectives, you have to make the plan first. If you make the plan, you'll get the objective. Next, you have to prepare the budgets. First, you develop a plan, financial plans. Next, you make budgets. Then what you do, you compare the actual with the target. Whatever actual performance happened, you try to compare it with the target. And next, corrective action. Take the action when performance deviates from plan. If the performance is not as per up to the mark, you have to take some action to ensure that in the future it is up to the mark. And finally, use performance evaluation to improve future decisions. Right? Try to do the evaluation of the performance so that in the future you can improve, and in the future you can get a very good marks. Okay, it's just like basically if you look into your mock marks and the mock marks are not as par, you'll see what can you improve, what you can do better, and then you will improve your future performance. Okay, so that is about this future planning and control. Okay, you develop the planning, financial plans, you prepare the budgets as well, compare actual with the budget, and then take action when there is a variance, and use performance evaluation to improve the future decisions. Okay, let's go through this quickly, Shrey.
So when we look at financial planning and control, first
Yes.
the planning process. So for any company to achieve its business objective, there should be a proper predefined financial plan.
Perfect.
Then there should always be a budget setting. They should prepare budgets for
Yes.
operations.
Yes.
And then comes the comparing. They should compare the actual performance with what they have planned.
Okay.
And then corrective action should be taken when the performance deviates from the actual plan made. And then they should use the performance to evaluate and so that they could improve the future decisions.
Okay, perfect. Very clear, very simple. You understood it well. So that is about this. Next, we'll look into the management of risk. So what you have to do from a risk perspective, that is management of risk. So first of all, you have to determine the level of risk that is acceptable to the business. Not all level is acceptable to the business. So what is the level of risk that is actually acceptable to the business? Next, you will continuously monitor the financial risk and forecast that, okay, you have made a forecast. What is the current status? Constantly keep monitoring it. Try to reduce the likelihood and impact of risk as much as you can. Put some processes in place so that you can reduce the likelihood. Second, use financial instruments to manage financial risk. So what you can do is you can use financial instruments to manage financial risk. You can use financial instruments to manage any financial risks. You can use financial instruments to manage any financial risks. Very important. Use any financial instruments to manage any financial risk. Finally, diversification. Spread the investments. Don't put all your egg in one shell. Spread the investments to reduce the overall risk. So you have to ensure that you spread the investments. Spread the investments to reduce overall risk. Spread the investment to reduce overall risk. Okay, so that is it about that. Make sure that firstly, determine what is the risk appetite of the company. Constantly keep monitoring the financial risk. Get into risk mitigation strategies. Reduce the likelihood of risk. Hedging. Use financial instruments to manage the financial risk. Diversification. Spread the investments to reduce the overall business risk. Spread the investment. Spread it. Spread the investment across multiple investment. Don't just be invested in one or two forms of investments. Okay, let's go through the management of risk here, Shri.
Management of risk is first. You have to determine or know the level of risk acceptable to the
Yes.
business. Second thing is that you should continuously keep monitoring the financial risk.
Okay.
And then you should reduce the likelihood or impacts of the risk.
Perfect.
How can it be managed? Like this one more source is like through hedging.
Very
So
good.
you can also use financial instruments to manage
Yes.
the financial risk. And you should always diversify your risk so that will reduce the overall risk.
Perfect. Diversify your investment so that your risk is reduced. Okay, perfect. So that is about this. Diversifying your investments so your risk is reduced. So that is about the management of risk. Okay, done. Moving on here, value for money. Let's look into this. What do you mean by value for money? Okay, it ensures resources are effectively used and efficiently used to maximize value. So value for money ensures, basically what does value for money does? It basically ensures that all your company resources are used efficiently. That means zero wastage to maximize value. That everything is being utilized effectively. That whatever you have, you're using it very well. There are 4 principles here that you would see. And we look into economy, efficiency, and effectiveness. That are the 3 E's. And along with that, we just have one more is transparency. That economy, efficiency, effectiveness is something you would have already seen. And there's just one more that is called transparency. There's 4 principles over here. There's economy, efficiency, effectiveness, and transparency. Okay. So now we look into resource management. VFM basically it applies to inventory, labor, cash, and non-current assets. So it applies to multiple areas like you can see here. It can be applied to multiple areas just to ensure that the zero wastage is there and the maximum value is extracted from this. Good resource management, it supports financial stability and growth. It's basically a good resource management. It basically ensures there's no wastage, efficiently using all your resources. And performance measures helps to monitor and improve resource utilization. It helps to monitor and improve the resource utilization. At the end of the day, this just ensure that whatever you have, from that you're extracting the maximum value that is possible from whatever you have. It doesn't go into what you can have or what you should have or what you may have or what you will have. No, whatever you already have, extracting the maximum value from it. Okay, so maximizing the resource utilization. So whatever resource you have, it's not questioning your resources, it's saying to ensure the maximum that we can extract. That is what the focus is. Okay, so let's look into this here quickly, Sri.
Yes, so value for money is basically like using the resources so then they are used efficiently to the maximum value. So there are 4 principles. That's basically economy, efficiency, effectiveness, and transparency. Then we have resource management. Value for money applies to like all like inventory, labor, cash, non-current assets. Good resource management supports financial stability and growth. Performance measures help monitor and improve resource utilization.
Okay. So got a clear idea on this one, yeah? It's a new concept. Maybe have you studied this before, Shri? Value for money?
Yes,
Hmm.
we didn't. I think SBR also had a small
Okay.
part. But FM also had a small.
Okay, perfect. So this is pretty much about us ensuring that whatever we have, extract the most out of it. That is the main point that we are referring to here. Okay. Next, what we have done over here is we've broken down in those all the three aspects over here. Okay, effectiveness, transparency. Let's break that down first here. So how are we looking into economy? Economy is basically getting your inputs at the lowest possible cost. Right, not the lowest quality, only the lowest cost. Quality without reducing quality. This is very important that you are not reducing your quality. Next, cost control. Effective purchasing reduces overall business cost. Effective purchasing, right? If you purchase smartly, then overall business cost will come down, right? You have to ensure that you purchase from the best possible place at the best possible price. Next, you can negotiate better prices and supplier discounts. You can negotiate better prices and supplier discounts, right? We have to have smart procurement also. Next, low cost should not compromise product. Very important. See, once again, your low cost is low, quality is not compromised. And finally, bulk purchasing and energy efficient equipment will reduce cost. So this is all about reducing cost without reducing quality. It's all about reducing cost without reducing, minimizing cost of input without impacting, without impact on quality. Okay, without impact on quality. Minimizing the cost of inputs without impact on quality. Okay, minimizing the cost of inputs without impact on quality. Okay, economy is minimizing the cost of inputs without impact on quality. Minimizing the cost of inputs without impact on quality. Okay, very important. Minimizing the cost of inputs without impact on quality. Okay, without any impact on quality. Minimizing the cost of inputs without impact on quality. That is economy. Okay, so that is all about economy. That it just focuses on minimizing the cost. You're not having any impact on quality. Focus is just on cost. All right, let's go through this one quickly, Shri.
So economy is basically like lowering the cost,
Yes,
but then also not compromising on the quality.
very good.
That's the most important thing. And then cost control is like when you purchase, you always make sure that you purchase at the lower price.
Yes,
And when next is better prices and supplier discounts. You can always negotiate and go for that. And then lower cost does not mean like you can compromise your product quality.
yes. You have to ensure that the quality is maintained. Perfect. So that is all about economy. I think you've got a good idea. That's all about lowering cost, but not at the cost of quality, right? Just at the cost of the cost, not at any change in the quality. Now coming to efficiency. Efficiency is basically one easy way to remember is zero wastage. That's it. Here, when you're converting your input output in that whole process, there should be zero wastage. That's the simple meaning of efficiency. That you're ensuring that there is no wastage, no wastage, no wastage. So you're producing more output using the same fewer resources. You're producing this more output using the same resources. How can you make more output? And you ensure nothing is wasted. You improve the systems and methods. You're improving the systems and methods. What you're doing is you're improving the system and methods. Next, you're making a better use of labor, equipments, and materials. You're making a better use. Yeah, you're making a better use of labor, equipment, and materials. You're making a better use of labor, better use of equipment, and better use of materials. Next, lower cost. Efficient operations will reduce your production cost. Efficient operations will reduce your production cost. Okay, efficient operations will reduce your production cost. Right. Automation basically increases output while reducing the labor hours. So automation is one answer to the questions of efficiency. Okay, automation is one answer to the questions of efficiency. So firstly, you understood what is productivity. It's producing more output. Using the same resources, you're producing more. That is productivity. Using the same output, you're producing more. That is productivity. Using the same output, you're producing more. That is productivity. Right? Using the same output, you're producing more. That is called as productivity. Right? Same output, you're producing more. Same output, you're producing more. Same output, you're producing more. That is productivity. Process improvement, you improve the systems and methods to increase efficiency. What you're doing is you're improving the systems and methods to increase efficiency in your organization. Whatever systems you have, whatever methods are there, you're constantly improving them. Resource utilization, you're making a better use of labor, a better use of equipment, a better use of materials. You're making a better use. And finally, lower cost. You're ensuring your operations are very efficient and you're reducing the production cost completely. Right? What you're doing is you're reducing the production cost completely. And finally, example, your automation increases output while reduces your labor hours. So automation is one way how you can increase your output while at the same time reducing your labor hours. Okay. And if you are efficient, your production cost will come down, sorry. Next, you can make a better use of labor equipments and materials if you are ensuring that you are focusing on efficiency in your organization. And finally, process improvement. You have to try to improve the systems and methods as much as you can to increase the efficiency. And finally, productivity. Produce more output using the same or even fewer resources, produce more output. Using the same or even fewer resources, produce more output. Okay, produce the more output. Using the same or fewer resources, produce more output. Improve the systems and methods, resource utilization, lower cost, and automation is one example of efficiency. All right, let's go through this, Yashri. How have we understood this?
Like every time a company focuses to improve its efficiency, it makes productivity better.
Yes.
Like you produce more output using the
Yes.
same resources.
Yes.
And then it also helps in process improvement.
Hmm.
It improves when you improve your systems and methods, it increases efficiency.
Yes.
And then it makes, when you focus on efficiency, it makes better use of labor, equipment, and materials.
Perfect.
And then it also lowers the cost. That will help in reducing the production cost. One example is automation. It helps in increasing the output. At the same time, it reduces the work, the labor.
Yeah, okay, perfect. Yeah, this is relatable, Yashi, from what we have studied and we know about it. Yeah, it is similar concepts, right?
Yes, sir.
Okay, perfect. Let's move on now. Quickly, let's aim to finish this particular reading in today's session. Effectiveness. Now, what about effectiveness? Effectiveness is basically your output should meet your objective. So, see, at the end of the day, you're doing ACCA to get a good job. So, your output is the ACCA degree, but your objective is a good job. So, your output should meet the objective. If your output doesn't meet the objective, then you should question the entire ideology behind the process that you are undertaking. At the end of the day, once you qualify ACCA, you should get a good job. So if your output is ACCA, objective is a good job, your output is not meeting the objective, what's the point? Output is not meeting the objective, what's the point? So what you have to do is measure whether business objectives are fully achieved. Is your output meeting your objective? Is your output meeting your objective? Next, output should contribute to desired outcomes. Your output should contribute to outcomes. Okay. Output should contribute to get desired outcomes, right? Our output should meet the objective, output should meet the outcomes, right? Next, this is about efficiency. Yeah, let's go through efficiency quickly. Yeah, Shri, are you there?
Yes, sir. Yes.
Yeah, just let's go through here with the effectiveness. Just 2 points are there on effectiveness. Let's close effectiveness here.
Yes, sir. So when we look at effectiveness, it's that it's simple as it is. It's that the objective should always meet with the output.
Okay, your output should meet with the objectives. Okay, so you have an output of your system. That output should meet the objective of the business. Okay, perfect. So that is all about effectiveness. Okay, and goal achievement.
Is that the output should always contribute to the desired outcome.
Yeah, okay, perfect. So that is us finishing efficiency, economy, and effectiveness. Now coming to the next part, that is transparency and accountability. So transparency is basically to ensure financial spending should be accurately recorded and reported. Everything should be accurately recorded. Everything should be accurately reported. And clear reporting. If you do clear reporting, you will observe that clear reporting builds trust among stakeholders. If there is clear reporting, it builds trust among stakeholders. So clear reporting basically builds trust. If you do clear reporting and good reporting, you'll see there will be trust that will be built. Next, we'll look into publishing financial reports, improves transparency. So whenever you publish financial reports, it improves your transparency. To ensure there has to be good accountability and there should be good transparency because that will increase the trust. Okay, let's go to transparency and accountability, Yashi, quickly.
So every company should be transparent and they should be accountable.
Yes.
So all the financial spending, it should be accurately recorded and reported.
Very good.
And the company should be accountable. So that helps in building trust among the stakeholders.
Very good.
So one example is that when a company publishes their financial reports, it improves the
Transparency. People trusted a lot more. Absolutely right. Perfect. So that is all about us finishing 3. So now see how the structure of the chapter has gone. First, it told us in the starting about here the financial manager's role. We saw the primary role. Yeah. Quickly, what is the primary role here, Shri?
maximizing the
Shareholder wealth. Perfect. After that, we looked into various other objectives also that are there. Yeah. Anything one or two that you can recollect, Shri?
Sir, about the they should always retain the profits.
Yeah. Okay. There should be a good distribution policy.
Yeah, good distribution policy, and then
Okay, one more.
There should be appropriate capital allocation.
Very good. You have to ensure that you're allocating the cost. Okay, fine. If you remember two, that's good. And these are all of the others. Okay. Ensure that you're getting the lowest cost possible, and making sure there's planning and control is strong, risk management and communication with stakeholders is there as well. Okay, so these are all the efficient and effective use of resources. Under this, we have seen VFM. Okay, so you see how VFM is also getting together with the chapter under the last part. When we say efficient and effective use of resources, here they have introduced VFM, and that's how we have studied VFM as part of this. Okay, so that's important. So see, you have to have the overall idea in your brain about the structure of the chapter, so that when you study, you know exactly you're fitting it in that structure. Just reading the content is a very naive way of looking at it, especially at P level. At P level, you have to see how the chapter is coming together. Okay, so when you break down the chapter and you see how it's coming together, and from that perspective, when you study, you will see that you'll retain so much more. Okay, so these are small mental models that you have to, slowly adapt. Okay, which will be very useful for you. Okay, this is the mental model that not only about studying the content, it's all about being aware with the context. Okay, so if you just zone out, you will just see that you'll miss the context. That's why I'm making sure that I'm keeping you awake. I'm making you just explain it to me, but that you see will help in the long run. When you revise in the night today, you will see you'll remember so much of it, and very naturally you'll remember. Why? Because you were more aware in the class. Okay, so just make sure that don't only remember the content, focus on the context also. That what is happening in the background, how the chapter developing itself. So you will just remember, see how well you'll remember everything after that. All right, let's go. Move on. Here, next part, VFM is completely done here. Next is treasury function. So now this goes into a different part of the chapter now, because if you see the name of the chapter, how it worked initially, it's about the manager's roles and responsibility. We looked in the primary role, various other roles, that is completely done. Now we are starting a new area of this, that is around treasury function. Okay, so this is now us going into another area in this chapter. So this is one area of the chapter done. So now we are moving into treasury function now, which is another area of the chapter. Okay, so I'll just put one green line here, so you know a new area is starting here. Okay, so whenever you see this green, just remember in the notes, now we're going into a different part of the chapter. Like that, mentally, you have to keep a structure of the chapter alive in your minds. That you will see how clear you will remember things. This green line, as untidy as it looks, this will just tell you this is one element of the chapter. And now we are moving into the other element. Okay, this is about the roles and responsibilities. This is where the chapter started. Now, next area, we look into the treasury function. Very important to get a good understanding of the treasury function. The treasury function basically manages the financial risk and the funding activities of the company. Financial risk and funding activities is something taken care by the treasury. Modern businesses require specialist treasury expertise. Modern businesses, they require some treasury expertise because they are global most of the time, so they require some specialist treasury expertise. International operations increase the challenges because see, when you go international, your business becomes international, it increases a lot of challenges. So you need some expert services. And risk management, risk manages finance, treasury manages the financial opportunities and risk. Main thing that they look into is financial opportunities, they look into financial risk. It supports organizational survival and growth. It supports organizational survival and growth. It also supports organizational survival and growth. Okay, so firstly, it measures the financial risk and funding activities. So if you see here, the first and the last points are pretty much the same. It supports organizational survival and growth, and it manages the financial opportunities and risk. So this is what treasury does. right? Financial opportunities, financial risk. It supports organizational survival and growth, and it manages financial risk and funding activities. Currently, modern day business have all become global. That's why you need an expert. That is the specialist treasury expertise. Okay, modern businesses have become very modern businesses have become modern business have become very complex, so that's why it's very important to ensure that there are some experts in the organization which are specialist treasury expertise. And what does treasury help in? They manage financial risk, they manage funding activities, they look into financial opportunities and risk, they support organizational survival and growth. Okay, let's look into this here quickly. Shri?
Yes, so when we look at treasury, the function is that the treasury manages financial risks, funding activities, financial risks, and
Yes.
opportunities. And then they also support the organizational survival of the organization and growth. So due to the now, like most of the businesses are like global and all that, so to reduce the complexity, they need specialist treasury
Very
expertise.
good.
And also international operations increase the financial management challenges, so they require an expertise.
Exactly. So they need someone with the treasury expertise. Perfect. So that is about why there is even a need and what they actually do. We have studied this. Why there is a need and what they actually do. Okay. So now we look into drivers of treasury management. Okay. What are some drivers of treasury management? What is really driving some treasury management here? So first is specialist expertise. Okay. First we look into treasury expertise. So first we need a specialized skill development. Okay, sorry. So when we look into drivers of technology, so here there are some drivers. So what are really driving this? Okay, so first of all, technology. Financial technology creates new opportunities and risks. So a lot of new technologies have come. If you see AI, blockchain, so whenever there's a new technology, there are new risks, new opportunities. So you need someone who has the kind of expertise needed to handle these. International businesses, because businesses have now become global, they have become international. That's all the more reason why we need this. Next, currency movement affect international transactions. Currencies are constantly moving. You see the pound, you book your ACCA exam now, we use book it in December, you will see the pound would have moved so much. And finally, interest rate changes impact the borrowings and investments. Interest rate changes. Your interest rate changes, what they do, they impact the borrowing, they impact the investment. Your interest rate is also changing, exchange rate is also changing. So see, this is easy to remember. Interest rate is changing, exchange rate is changing, technology is changing, businesses are becoming global. And finally, restrictions increase cross-border financial activity. Now there's a lot of global business. You see so much Chinese business in India, Indian business in Chinese. So in China, so reduced restrictions, it basically increases a lot of financial activity across border. There's a good chance of fraud. So it becomes very important, or any discrepancy. So it becomes very important to have a good expert treasury function. Okay, so this is all of this simplified here. Okay, let's go through this here. Why do we really need a treasury department? Yeah.
Okay, the need for a treasury management is first. The first is that technology. Financial technology creates new opportunities and risks.
Very good.
Then globalization is international businesses. It
Yes.
increases the complexity. So that's the most important need for
Yes.
the treasury management. And then it also includes like exchange rate risk and interest rate risk.
Very good.
So currency movements affect international transactions, while interest rate changes impacts borrowings.
Okay.
And then we have exchange controls, reduce restrictions, increases cross-border financial activity. So because of all this, it is important that to have a treasury manager.
Absolutely right. Yeah. Good job. So that is about this. Now, benefits of a dedicated treasury function. If you have it, what are the benefits? This is why you need it. Now, if you have it, what's the benefit to you? Right. So they develop treasury professional developed advanced financial market knowledge. So they have advanced financial market knowledge, right? Centralized treasury reduces the financing cost also. If you have a centralized treasury, it reduces your financing cost of your company. Treasury optimizes liquidity and funding. What Treasury does is it optimizes liquidity, it optimizes funding, and finally, better negotiation. Large borrowing power improves financing terms. So, if you have large borrowing power, right, that means if you have a very big company, what happens is you have a larger borrowing power, and the banks will give you money at a better rate. So, you need money for all the offices you have across the world, right? Now, if you say Uber is across the world, it's global, right? Uber is across the world, Uber is global. Okay, Uber is across the world, Uber is global. So if they want to borrow for all the Uber outlets, so imagine how much money they can borrow from the banks. So because they're doing wholesale, this thing we do this, right? We go to a vegetable shop, we buy a lot of vegetables because there's a feast at our home. So they reduce the cost of the vegetables because we are producing in large quantities. Because we are producing in large quantities. Okay, because they're producing in large quantities. So because we are ordering in large quantity, they reduce the cost. Same thing over here. If you borrow in large quantity, they'll reduce the interest rate. If you borrow in large quantities, they'll reduce the interest rate. So better negotiation. Next, cash management. They optimize liquidity and funding. Right? They optimize, they ensure that there is the best possible manner. You have the most amount of liquidity and funding. Economies of scale, centralized treasury. So if you're making a purchase decision, so see, when one shop buys for everybody, like Big Bazaar worked on this only, right? They placed an order for all the Big Bazaars, and all the Big Bazaars had so much quantity. So imagine when you purchase on that quantity, how much reducer in cost they used to get, how much discount they used to get. But they used to sell at a good discount to us also and at good at MRP. So we used to love Big Bazaar, that yes, it's great that there's so much offers and everything is going on. But because Big Bazaar ordered for all its outlet, it gave such a huge purchase order that they got at an amazingly low price, and that was the whole point of economies of scale, right? So whenever you do anything at large scale, it per unit cost reduces and you get at a very cheaper price. Okay, let's go this here. What are the benefits here? Let's look to see our understanding.
So benefits of a dedicated. Am I audible?
Yeah, clearly.
Okay. So benefits of a dedicated treasury function. First, a specialist expertise will always help to develop, will always have good financial market knowledge. So,
And because of them, the company will have it. Okay, because of them, the company will have it. That's it. Okay.
Risk management could improve the management of financial risk.
Very good.
So economies of scale always reduces the financing cost. And then treasury function for cash management, optimize liquidity and funding. And there's also better negotiation because of the larger borrowing power.
So there's a better negotiation here. So you have a larger borrowing power, and if you have that, you can improve your financing terms. You can get at a very cheap price. You can get at a very cheap interest. You can get your loans, and at a very cheap price overall, you can get the money. So that is about this.
सर दूसरा मेरे को 1 2 3 से शुरू करना है, क्या करना है?
तीसरा महीना,
हाँ
ठीक है, डेट बदल रहे यहाँ से फिर 2 लाइन छोड़ के. So that is about this. Moving on now, treasury versus financial control. Treasury versus financial control. Let's look into this here. So what is treasury? What is financial control? What is treasury? What is financial control? Let's look into the differences. Okay, we are almost there. Okay, so what we'll have in plan is finish all the TYUs and the exam kits some tomorrow, and we are pretty much looking to finish the topics here. Again, we have included most of the topics. All right, it will just take us such this another session. But good, yeah, I think we got a decent amount done. But we'll have to look to close this chapter because we shouldn't go in any chapter more than 3 days. Right. So today is technically the first day, as we had just done an orientation yesterday. So we have done first. So maximum by tomorrow we will look to finish this chapter. Okay. And we will do all the TYUs and illustration that are there. Along with that, we'll finish all the exam kit problems. So here only what we'll do is once the chapter gets over here, we'll do all the TYUs, and here only we'll do all the exam kits. So everything will be in one slide only for you. In one Excel file, if you just go through end to end, everything is revised. Don't need to refer to multiple sources. Okay, so today your job is just to make sure you revise everything really well. Okay, we'll put it in our study tracker as well. So what we are doing on 24th July. Okay, so what we are studying over here, we have done chapter 1, part 1 basically here today. Okay, so here we did a paper introduction. Okay, and we will give this for every. Okay, so just to make sure at least 5 to 6 times, yeah. Make sure you just read everything very clearly and be on top of this. Just to make sure that you are giving ample time to chapter 1 today, and just after that only revision. Okay, so today and tomorrow is the only time ever in the next 1.5 months you're going to dedicate to AFM chapter 1. After that, chapter 1 will only go to revision. Okay, from tomorrow is the last day you're going to give time to chapter 1. After that, it will just be a chapter that you have to only revise. That's it. There's nothing to study there. You're doing this is active studying with me. I'm explaining, you're repeating. I'm explaining, you're repeating. Okay, active study is happening here. After this, only revision is there. Now, 6 times you have to read it today, and tomorrow, whatever is remaining, 6 times you read everything, get on top of everything, be strong on that. Then, after that, tomorrow, sums are also done, and then only revision of chapter 1 till the day you write your exam. Just this one Excel file, end to end, you have to revise. That's it. Now, okay, so tomorrow we'll finish our TYUs here and finish our exam kit. So, see, today, what you also do is here in the chapter 1, leave a good amount of space, start from anywhere between 100 and 15 onwards. You stick the TYUs, question answer, and under each other, right? TYU 1 here. Okay, in this, like I'll just show you TYU 1, and just stick the question over here and stick the answer over here next to each other. We are basically even making your own notes for your exam revision also. Okay, so how many ever TYUs are there? Just in a clear way, keep it short only. Don't increase the picture size. Keep it little small that you can just read in an organized way. Just take all the question, answer. Tomorrow we'll finish it off. Okay.
Yes, sir.
Exam kit, I will do it. Just TYU, you do it today. Just put the snips over here. Okay, you have already this resource, and let's make a very strong revision notes for you as well.